Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to the current session on long-lived assets held for use where the accounting shall be done by the revaluation model. This forms part of your FRA level 1 which is reading 30, which deals with long-lived assets. Before moving on to detail, it is imperative that we look at the session on the basics of long-lived assets. We should be aware what is depreciation, we should be aware what is historical cost, terms like salvage value, different methods of depreciation, which is really the precursor, or should I say the prerequisite, to look at the revaluation model. Moving on to the specific of revaluation model, let's create a context as to where does a revaluation model comes into picture. Now under IFRS, there are different models for different categories of long-lived assets, or should I say the different intentions by which I purchase my long-lived assets. What I mean by intention is I can purchase my plant and machinery or a piece of land or building just for the purpose of investments without any intention of using it. There we follow fair value model, for which we have addressed as a separate session already. In case of the plant and machinery, which are 99% of the case, they are purchased not for the purpose of sale. They don't, the businesses don't want to make money by selling their long-lived asset. They want to make money by using it and producing inventory, because at the end of the day, that's what is their activity, the operating activity is all about. So for assets which are held for use, my IFRS allows two different models, absolutely a choice of the company. In case of historical cost model, the aspects like original value to be arrived at as per capitalization then needs to be depreciated, occasionally needs to be impaired, so on and so forth. So all that stuff keeps happening here, which is why I said, that it's going to be like a little prerequisite before this. My current focus will be the revaluation model, wherein different rules of accounting are followed, but I want all the students to understand that this is applicable only under IFRS, number one, and only for assets which are held for use. Well, things are very simple and straightforward under US GAAP, where they follow just one single model, historical cost model. Doesn't matter the asset is held for use or investment property. So moving on to the details of revaluation model, the meaning and the accounting aspects. Again, the key point, like I said, only under IFRS, which are held for use. So these are the 2 points that you always need to remember before application of reval model. It can be done by cost or revaluation, no such concept. We have talked about that. Jumping on to the rules of accounting, 2 important things to be remembered. One, that the valuation is done at fair price, the fair value. There is no historical cost concept and no depreciation. We're going to take a practical example for that. Any increase or decrease in the fair value, let's say it was entered at X, now the fair value is Y, so this delta needs to be accounted for in a specific manner, and this is sometimes confusing to the students. It says the increase or decrease, that means this delta is taken to point number A, income statement, or point number B, to OCI. That means there are 2 places where this delta can go. Let's try and understand which case gets applied when. If the change is below or up to the historical cost, then I'm going to follow my income statement, and any change above the historical cost will directly impact my equity, which is my other comprehensive income. That means no PAT will come into picture. I'm sure this part can be understood only with help of an example, but before that example I would like to explain that with help of a diagram. Let's say this is my historical cost X, and there has been a movement upside from X to, let's say, Y. Now this delta is above the line, therefore any change in the fair value, I am reiterating, Any change in the fair value above the historical cost needs to go to the OCI, and any change below the historical cost, either increase or decrease, will go to the income statement, whereas up and down is the movement of fair value. Now I'm sure we are absolutely craving for a good example, which is right here. Says that a building was purchased by Apple for 10 million on 1st July for office purpose. Now this part signifies that it is not an investment property, but for office use. Now the market value on different dates was so and so, 13, 11.5, 8 and 9. What should be the impact on financial statement if we follow the fair valuation model? Solution. If on 1st of July my A is equal to L plus C, my cash would have gone down by 10 and my building would have gone up by 10. So this is like the mother transaction for the purchase. 31st of December 2012, the value is 13 million, which means an asset of 10 has become 13. My fair value model says that balance sheet value should always be the fair price. That means my assets have gone up by 3, no change in the liability, so the gain, obviously the unrealized gain, should be recognized in capital. However, the key question is which part of the capital. Now again, my diagram here which says any change. My historical cost is right here. I am raising it to 13, which means to say that this movement is above the line, therefore this should go to OCI. What I've done is I have added the particular diagram here itself, so it will be easier for everyone to understand. The value from 10 have gone up to 13. This movement is above the line, therefore goes to the OCI. Now in the next year, from 13 it has become 11.5. So on the balance sheet date, it will still be entered at the fair price. That means a fall of 1.5 million US dollar. This needs to be recognized as a loss. Now the question is, in which of the two, income statement or OCI? I want you to note very carefully that from 13 I am moving downstairs, but still I haven't crossed the historical cost line. I am still above that. So this movement also, although it's a downfall of 1.5, but still is above the historical cost. Therefore I am going to impact my OCI. Okay. The question of OCI versus income statement is not about increase or decrease. You can see that both the territories have both the arrows. The question is, does that increase or decrease fall into above the line or below the line? For example, in the third year 2014, the fall has been pretty evident, which is of 3.5 million. So my value goes down by 3.5. My value of the asset in the balance sheet is reflected at 8, which means a loss of 3.5 needs to be booked. I want everyone to pay very close attention. From 11.5 I have came down to 8, which means there is some portion which is below the line, which is 2, needs to go to income statement, and there is some portion, I am going to highlight that with blue, which is above the line 1.5, which needs to go out of OCI. So if you look at the total, change in the capital, so to speak, or comprehensive income, so to speak, is 3.5, which is right here. Fairly simple to understand with help of the example and this diagram. The next year, the assets are again upward revalued by 1 million. That means from 8 there has been an upward movement, but the key point is you haven't crossed the line, you are still below it. So the increase of 1 from 8 to 9, the value will go up by 1. This will have to be booked as a gain, and this increase needs to be again booked to income statement because still it is below the line. So I really want we can go on and add as many years as possible, but I want everyone to kind of pay attention to this part of the session where we have explained it by help of a diagram. Anything above the line, any change, increase or decrease, goes to OCI directly, and anything below goes to the income statement. Let's look at the second example, very small. I just wanted to make one smaller point. Let's say an asset which was 10 in my previous example had gone up and then came down later upon. In this case, I am saying my assets have initially gone down, again using the same diagram, from 10. Now this time I am moving in the downward territory first. That means it is below the line. You got to measure it at 8, and the gap of 2, from 10 it has become 8, so the loss of 2 will be first booked in income statement. And of course, in the next year the value goes up to 12, so the value is 12, goes up by 4, and out of this 4, 8 you have become 12, so above the line is plus 2, and below the line is also plus 2. The objective of taking the example was that the language of the law, it complicates the student sometimes. The law is very complicated. It says if initially there is an increase, then decrease, the accounting should be done in proper manner, etc, etc. But my simple submission is, don't get confused with any kind of a legal aspect. Just focus upon this simple diagram. So I hope the current session was useful. You can subscribe to our channel on YouTube, Finstudyclub, for more such videos. Should you have any question, query or doubt that you would like to take us, please email at finstudyclub@gmail.com. We would be more than happy to address that. Thank you very much.